Welcome to the Deep Dive, where we unpack the numbers and the narrative behind the market's biggest moves.
Today we're looking at the Cigna Group, ticker CI.
And specifically, their Q3 2025 earnings call on October 30th, which was a day of absolute shock for anyone watching.
It was a brutal day on the street, and our mission here is to really unpack that colossal disconnect.
Right. Because the company delivered a clean operational beat, their current business looks great.
And yet, the stock plummeted. We're talking 17-18% intraday.
This wasn't a miss. This was a panic-driven sell-off based entirely on what management said about the future. We need to figure out why.
Let's do it. So maybe we should start with the good news, the stuff that got completely buried.
Yes, let's start with that operational snapshot. Because on paper, Q3 looked great.
Absolutely. The core financials were really robust. Adjusted earnings per share came in at $7.83.
Which beat the street's consensus of what, $7.65?
Exactly. An 18-cent beat. That's a 2% surprise, which, in managed care, that's solid execution.
And the top line, the revenue, was just as strong.
It was. Revenue hit $69.7 billion. That just sailed past expectations.
So we're talking about 10% year-over-year growth.
10%. And that was mostly fueled by the Evernorth segment. That's their health services and PBM arm.
And importantly, they stood by their full-year guidance.
They did. They reaffirmed their full-year 2025 adjusted EPS outlook of at least $29.60.
So if you just read the press release, you'd think, great quarter, stock's probably up.
You would. Instead, shares closed down 17.39%, lost over $52 a share.
It tells you the conversation was not about Q3 at all. It was all about the future. And the options activity, it was aggressively bearish.
Totally. The Q3 numbers were ancient history the moment they were spoken. The entire story hinges on Evernorth, specifically pharmacy benefit services, or PBS.
Okay, so let's unpack that. Management laid out two major strategic decisions that just spooked everyone.
That's right. And they're both designed to future-proof the business, but they come with a really immediate and, painful price tag.
So let's start with the first one, because this is where the whole industry is focused right now. The PBM model itself.
The first driver, and you could argue the most important one, is this massive strategic pivot. They are moving to a rebate-free pharmacy benefit model.
And you have to understand the context here. The old model with the post-purchase rebates, it's seen as really opaque.
It's seen as opaque, and it's drawn a ton of fire from D.C. There's this constant fear of legislative changes coming down the pike.
So this new model gets rid of that.
It does. It replaces that complex rebate process with a simple upfront discount right there at the counter. The company is framing it as more transparent, more patient-friendly.
And they plan to roll this out starting when?
They're aiming for fully insured lives starting in 2027, and it becomes the standard offering by January 2028.
That sounds like a brilliant defensive move. Get ahead of the regulators before they force your hand.
It is, but
it's got to be incredibly expensive.
It's extremely expensive. And it introduces huge execution risk. Management was very clear about this.
What did they say?
They warned that this transition, recontracting with thousands of pharmacies and clients, upgrading all the tech, re-engineering core processes, it's going to mean substantial costs.
And that's going to hit the PDS segment hard through 2026 and 2027.
Exactly. They are intentionally sacrificing near-term margin for what they hope is long-term insulation from political risk.
Okay, so that's headwind number one. What was the second factor that crushed the Evernorth outlook?
The second was the proactive disclosure of renewals with three, just colossal clients.
Right, Prime Therapeutics, the Department of Defense, and Centene.
Yes. And together, these three represent something like $90 billion in annual revenue. It's an astonishing number.
Securing $90 billion in revenues seems like a huge win. So what's the catch? Why did the market hate that news?
The catch is the price. They locked in that volume, that durability, through the end of the decade. But they did it by giving these clients much better economic terms.
So they sacrificed margin for volume.
They did. You could almost call it a strategic fire sale for their biggest customers. These new terms mean a permanently lower margin profile for those specific contracts.
And how much did that one move hurt the outlook?
A lot. That repricing action alone accounts for more than half. More than half of the total expected decline in PBS income for 2026.
Wow. So you add the cost of the rebate pivot to the lower profitability on $90 billion of revenue.
And the result is clear. Management is telling you to expect margin compression in that PBS segment for the next 2 years.
Which is why they guided that Evernorth's overall pre-tax adjusted income, or AIFO, is going to decline slightly in 2026 from that $7.2 billion they expect this year.
That's the whole story. If you're a short-term trader, you just heard that 30% of the company's earnings engine is taking a deliberate 2-year haircut.
And that's why the stock plummeted.
That's it.
Okay, but this is where it gets really interesting. If 30% of the business is slowing down on purpose, where is the company finding the confidence to reaffirm the 2025 guide? And more importantly, to project overall EPS growth for 2026.
This is the key. They must be banking on the other 70% of the business to be just running red hot.
And they are. The company is leaning on two very powerful offsetting growth engines.
Exactly. That other 70% is projected to grow at the high end of their long-term models. It's just enough to absorb the PBS hit and still deliver growth for the whole enterprise.
Let's look at the first engine then. Specialty and care services, which is also under that Evernorth umbrella.
Right, and this is the clearest growth story they have. It put up 11% adjusted earnings growth in Q3, and it's expected to grow toward the higher end of its range in 2026.
And a key part of that is their investment in Shields Health Solutions, right?
It is. Shields is their big play in the provider-administered specialty segment. It's a huge market.
Explain that for us. Why does Shields matter so much?
The specialty drug market is about $400 billion. And 40% of that, 40%, is for drugs administered directly by a doctor in a hospital or a clinic.
So not something you pick up at the pharmacy.
Exactly. And Shields gives them a platform to capture that volume, manage that complex care, and really change the profit structure of their specialty business.
And you also mentioned biosimilars.
Yes, they're seeing really strong adoption of biosimilars for drugs like Humira and Stelara that helps them control costs for their clients and drive adoption.
Okay, so that's one growth engine, about 30% of earnings, humming along. The other 40% is Cigna Healthcare, CHC, the insurance arm. What's the story there with the medical care ratio, the MCR?
The MCR was a bit high this quarter, 84.8%. It's up from about 82.8 last year.
Not a disaster, but it does signal higher medical costs.
It does. It was driven by two specific things: higher stop-loss costs and an update to the risk adjustment in the individual exchange business.
Can you just quickly break those two down for us?
Sure. Stop-loss is basically insurance for employers for catastrophic claims. Those costs went up. And risk adjustment is a mechanism in the ACA exchanges. It's basically an accounting true-up that was a bit more expensive this time.
So costs were up. What's their outlook for that?
For 2025, they guided the full-year MCR to the high end of their range. But for 2026, the outlook is actually very positive.
How so?
They expect CHC operating income to grow toward the high end of its target. And that's driven by corrective pricing actions they've already taken on that stop-loss business. So they're fixing the problem.
So if you connect all the dots, it becomes really clear. You've got CHC and specialty services. That's 70% of the business, both delivering really robust, high-end growth.
Right. And that 70% is basically engineered to absorb the margin hit from the PBS transition,
allowing them to still project overall EPS growth for 2026. It's a 2-year investment cycle.
That's the structural takeaway. Management believes their diversified model is a shield. It lets them take this calculated hit to the PBM now to set up a much stronger, more durable business after 2027.
But the market had absolutely no patience for that. That 17.4% drop on massive volume, it was a total rejection of that long-term story.
The market is supposed to be forward-looking, but it focused entirely on the near-term pain.
Why? Why do that?
It comes down to two things: near-term margin compression and execution risk. The trading floor doesn't look at the 2028 payoff, it looks at the 2026 risk. What we saw was a sharp multiple derating.
Translate that first. What does a multiple derating actually mean?
It just means the market now thinks the company's future profits are much riskier or less predictable than they thought yesterday.
So they're willing to pay less for the same earnings stream today.
Exactly. They're heavily penalizing the stock for that perceived risk.
What were the analysts saying? Was everyone on the same page?
Not at all. They were pretty divided. You had Mizuho calling the $90 billion repricing a surprise that hurts the near-term story.
Okay.
But then you had others, like Leerink, who viewed the massive sell-off as just overdone.
And that tension really sums it up, doesn't it? Is it worth an 18% hit today to secure that revenue and future-proof the business?
That's the whole trade. And you have to remember, the stock was already fragile. It was down about 22% over the past year because of all this PDM and regulatory anxiety.
So what do investors need to watch now?
Three things. First, the Q4 results and the official clear FY26 guidance. Second, the competitive response. Do rivals follow them down this rebate-free path?
And third,
And third, execution. They have to hold that Cigna healthcare MCR within their guided range. If medical costs spike again, that growth engine won't be enough to offset the PBM drag.
it's all about changing the narrative from fear back to durable growth.
Precisely.
All right, now for the part of the show where we get to play armchair strategist. A reminder to everyone listening, this is purely for entertainment, a thought experiment. It is unequivocally not financial advice.
Right. So our view is that the market fundamentally mispriced the durability factor here. It overpenalized the stock for a temporary, self-imposed margin reset that's designed to protect its future.
So you're with Larink, the sell-off was overdone.
We think so. The stock fell 18% on the perception of risk, even as they reaffirmed their base value for 2025 and projected growth for 2026.
So lay it on us. What's the outrageous but plausible trade idea?
The thesis is all about long-term strategic patience winning out over short-term market panic.
Okay.
So the trade idea is to initiate a deep value long-term durability position using long-dated call options.
How long dated are we talking?
You'd be looking out to 2027 or even 2028 expiry dates. The bet is that once this 2026-2027 investment cycle is over, the benefits of that protected $90 billion in volume and the future-proofed PBS model will finally shine through.
So you're using options to get leverage on that recovery and re-rating once the market sees the path is clear.
It's a bet that management's strategic sacrifice actually pays off, and pays off big.
Which brings us right back to where we started. That core tension between a clean operational beat today
Versus a sharp market derating due to a strategic, self-imposed, 2-year PBM margin sacrifice for tomorrow.
So the final thought for our listeners to mull over.
The key question moving forward is this. Will locking down that $90 billion in revenue and committing to this transparent PBM model truly insulate them from competitive and regulatory pressures for the next decade?
Is that long-term gain worth the immediate, very real 18% pain?
That's the question. It's a calculated, painful gambit, and we'll all be watching to see if it delivers.
Thank you for joining us for this deep dive into the Cigna Group's wild Q3 call. Until next time, keep exploring what's really driving the numbers.